And I agree that there's some risk. And look, if Bitcoin ripped from here to the end of the year, if we ended the year at 300K or something, then I think we could have a pullback. But I don't feel the euphoria. And I think these longer 5-year trends are just they're just really strong. It's still the case that most institutions don't own crypto. I think that will change in the next 4 years, and they have a lot of money. It's a tanker, not a speed ship. Yeah, I'd add one more thing that's been on my mind lately, which is the Bitcoin obituaries chart.
Oh yeah, more well, yeah.
Yeah, there's been few of those recently, right? Because most people now accept that Bitcoin is not going away. And one of the reasons I think we had these 70% pullbacks was there is not many value buyers of Bitcoin. It started to fall and everyone was like, oh, it's over, it's going to zero. But if people no longer think it's going to zero, I wonder if the cushion comes in sooner, right? Like if we pull back below 100K, are there people who are going to buy instead of letting it continue down to 50 or something like that? I think that may play a dynamic here as well.
The cryptocurrency market has begun to enter a new phase after the introduction of Bitcoin ETFs, one that may differ significantly from the previous 4-year boom and bust pattern. Bitcoin's halving events have historically set the tone for cycles, but Matt Hougan thinks this trend is waning. Because the real drivers propelling Bitcoin and the larger digital asset market today are institutional acceptance, regulatory changes, and global liquidity. If you're intrigued by bold predictions and deep financial insights, make sure to like this video, subscribe to the channel, and turn on notifications for more engaging content. Thank you for your support and enjoy the video.
It served me well, so why should I abandon it, man?
But it's a good point. I've been a fan of the 4-year cycle, and you can't dispute that it's been true, right? 2014, 2018, 2022, all terrible years. The core reason I think it won't be true in 2026 has two halves. On one hand, I think the forces that have driven the 4-year cycle are weaker today than they are in the past. You mentioned the halving. I think the halving is programmatically half as strong every 4 years. And you can make arguments around that. But if you think out 50 years, you have to imagine the halving is not that important. We're not talking about very much Bitcoin before and after each halving. So I think the halving force is half as strong. We've also historically had rising interest rates in 2018 and 2022. I think we have falling interest rates this year. And then we've had blow-ups as well, FTX you mentioned, in 2022. And I think those are less likely now. So I see the forces that drove it in the past as weaker than they were in the past. And then on the other side of the equation, we have these much slower but very large forces that move on decades-long timescales. So the institutional adoption of crypto, which really kicked off with the Bitcoin ETF, started in 2024. I think that could run for 5 to 10 years of ever higher and higher flows. We have pro-crypto regulation. I think the impact of that will be felt over 5 or 10 years. So it's not that I don't think the forces that created the 4-year cycle in the past still exist. I think they do, but I think they're weaker. And now we have these 5 to 10 year forces that I think are stronger. And as a result, I'm not calling a super cycle. I'm not saying we've repealed volatility, but I think 2026 is going to be a great year. I think 2027 will be good too. If you think about an institution that just started thinking about Bitcoin when the ETF launched and does quarterly meetings, their 8th meeting will be in January of 2026. They'll be just entering the buying phase. So I agree you can have these animal spirits. We may have pullbacks. There may be a little bit of exuberance in the Bitcoin treasury market. I would say that crypto does not feel overly exuberant to me. This does not feel like 2017. It does not feel like 2021. It feels more early stage in terms of the cyclical excitement outside of the treasury space, which I agree there's a little bit pipping up right there. And I agree that there's some risk. And look, if Bitcoin ripped from here to the end of the year, if we ended the year at 300K or something, then I think we could have a pullback. But I don't feel the euphoria. And I think these longer 5-year trends are just they're just really strong. It's still the case that most institutions don't own crypto. I think that will change in the next 4 years, and they have a lot of money. It's a tanker, not a speed ship. Yeah, I'd add one more thing that's been on my mind lately, which is the Bitcoin obituaries chart.
Oh yeah, more well, yeah.
Yeah. There's been few of those recently, right? Because most people now accept that Bitcoin is not going away. And one of the reasons I think we had these 70% pullbacks was there is not many value buyers of Bitcoin. It started to fall and everyone was like, oh, it's over, it's going to zero. But if people no longer think it's going to zero, I wonder if the cushion comes in sooner, right? Like if we pull back below 100K, are there people who are going to buy instead of letting it continue down to 50 or something like that. I think that may play a dynamic here as well. Okay, so I think 70% corrections are in the past. I don't think we'll see that again. I just meant from the political standpoint, if one of the risks to crypto long term is a dramatic swing in the policy, I do think a market where crypto draws down substantially and Democrats focus on it is a potential scenario where there's risk. But again, I really don't think that's the base case. I think once we have regulation and crypto is in Wall Street and in portfolios broadly, I just don't think it goes back. I think we're in a new regulatory world. I think the ETF is a good example of that. Like, we can't not have an ETF. We have an ETF now. It's not going to disappear. And it's sort of a one-way door. And I think from a regulatory perspective, we're moving through those one-way doors. We moved through it on stablecoins. We're moving through it on market structure. I just think we're in a pretty strong place as an industry now.
Matt Hougan identifies institutional inertia as one of the main concepts he emphasizes. Institutions play a completely different game than regular investors, who frequently enter and exit the market at short notice. They consider temporal spans of 10 to 20 years while making judgments. For instance, a retirement fund makes an allocation and keeps investing consistently, frequently through automated flows rather than monitoring cryptocurrency values every week. And this is made clear when we examine the data from Bitcoin ETFs. They brought in almost $35 billion in inflows in the first year alone, demonstrating the strength of this long-term momentum. Also, a quick reminder, only a small percentage of viewers are subscribed. If you enjoy deep dives into crypto and finance, hit that like button and subscribe. It's free and helps the channel grow. Now let's get back and hear what he has to say.
Right, like the risk I see for people who feel strongly that this 4-year cycle will repeat is that they'll step out of the market and then the market will pass them by, and that will be a real challenge. And so to the extent that people are planning to do that, maybe do it in half or maybe do it at a lower level to make sure you have, and I know most real hodlers do this, they don't step out of the market, but make sure you maintain sufficient exposure that if these two factors, institutions and regulation, really do change the game, you're not at zero. But look, no one cries that much over taking profits on a position after a good 3-year run. So I'm not against that. I would just say, be open to the idea that this time it's different. It's happened 3 times. That doesn't guarantee it's a fourth. It hasn't happened 50 times, right? It's happened 3. If you imagine flipping a coin, you can get 3 heads, but that doesn't mean the fourth one will be a head. So I would just say, yeah, it just be open to the idea that it may be different. I think if you imagine a world without Bitcoin, the US is unconstrained in its ability to print money, because who are you going to fall back to, right? The US is unconstrained on the debt and deficit sides. In a world where the US embraces and allows Bitcoin to exist, I think it has a significant impact on how the government operates at a point. I think it constrains it. It could co-opt it eventually. But I do think it's more evolutionary than sort of parallel world structure. And it's a good risk to consider of that collapse time to the midterm elections, which would be dangerous for crypto. My base case is that the genie's out of the bottle and it won't come back in. And I would note that, the Genius Act passed with 100 votes from Democrats in the House. It's actually somewhat bipartisan. There's a very squeaky part of the Democratic Party that's anti-crypto. And I agree that in a sharp bear market, maybe with some scandals tinged to it, they would pounce on it. But I don't think that's the base case. I think the base case is that crypto demonstrates its value now that it's able to interact with the real world. The US is relying on stablecoins for financing its debt. Bitcoin is broadly held by pensions and institutional investors. And that part of the market just has escape velocity from a regulatory perspective, right? It's like the internet after the 1996 laws. It's now out there and it's demonstrated its impact on the world, and you can't stuff it back in. So your scenario, the negative scenario you played out is possible and would contribute to a 4-year cycle. It adds cyclicality to crypto if it happens, or maybe a pro-cyclical nature to a downturn. Like a downturn begets more downturn if it's time to the election. But my base case is it's actually bipartisan. The majority of Americans want crypto to succeed. It's important for our national security interests. It's important for our national economic interest. Wall Street is now behind it. I think it's out of the bag, and we're in this new, pretty good regulatory world. And just that they're slow moving. They don't move with the speed of retail investors who moved in and out of assets on a 4-year cycle as soon as the market turned, they were out. That's just not the way institutions act. They're allocating for the next 10, 20 years. Maybe listeners who have a retirement account from their job, it's not something they think about. They just invest in it every 2 weeks without even imagining what they're doing. That's sort of the way it happens in this space. So once you've made it into the club, once you're part of the portfolio settings, the market could be up or down. They're still going to be buying, and they just move at a different pace. It's like a different kind of investor. So I think that's going to play out for a decade. I think, ETF flows as an example. We did $35 billion in year one. I think we'll do $50 billion in year two. I think we could do $75 billion in year three. I think we could do more than that in year four. That's what ETFs tend to do. Flows tend to increase over time. And I think that's what we're going to see from institutions. I just think they're moving into crypto, and I think that's going to take multiple years, and that's going to overwhelm the sort of 4-year cyclicality.
Matt Hougan gives us a crucial perspective. Compared to previous cycles, cryptocurrency is in a very different state today. Hougan contends that the larger picture is significantly more important, even though there are always hazards, such as political pressures or a market decline timed around elections. According to him, the genie is out of the bottle, which means that cryptocurrency cannot be easily stopped or undone since it has been so integrated into global economics and mainstream finance. We no longer only deal with retail traders looking to make quick money, unlike in the past. These days, Wall Street companies, pension funds, and retirement plans are investing billions of dollars in cryptocurrency, and they don't think in terms of weeks or months. They make investments for several years. Because institutions don't buy and sell based on emotion, they continue to buy consistently even when prices decline, which results in a completely different market dynamic. Hougan also cites regulation as a significant paradigm shift. Crypto used to exist in a murky area where it was susceptible to abrupt crackdowns. However, the largest financial institutions can now interact directly with digital assets thanks to new regulatory regulations. The momentum becomes evident when you combine that with the fact that ETFs are growing and generating tens of billions of dollars annually. He thinks that ETF flows will only pick up speed, with $35 billion in the first year and even higher figures in the years to come. Since demand is already many times more than the supply of new Bitcoin, scarcity will continue to be a powerful price driver. Remember to like this video, subscribe to the channel, and enable notifications if you thought his viewpoint was helpful so you don't miss any updates. We'd love to know what you think about the future of cryptocurrency markets, so please share your ideas in the comments section. We appreciate your time and hope to see you in the next video.